Hello, good morning, everyone. Thank you for allowing me to speak. Glad to set off day number 2. I don't see the slides for this session on the screen. There we are. Okay, thank you. And if we could move one slide ahead to the agenda for this, I'll describe in a brief summary what we're going to cover today, or this short session of 15 minutes about LDTI. The Financial Accounting Standards Board is requiring changes to the U.S. GAAP accounting for life insurance. This is a massive change in the accounting standards, and LDTI stands for Long Duration Targeted Income. It's been in development for years, and it's recently become effective for public companies and will soon become effective for the non-public companies. The goal of LDTI, one of the goals, is to make the financials more transparent. And so I'll present 4 main areas impacted by LDTI as shown here on the agenda. These affect the way valuations are performed and the types of insurance products that are in scope for LDTI include traditional life insurance, limited pay life insurance, long-term care products, participating whole life, universal life, and then deferred annuities. These all reflect some type of long duration in their products, which is what the name LDTI is referring to. So if we could go to slide number 2, the first main topic is benefit liabilities. And benefit liabilities represents the present value of the expected benefits less the present value of the expected premiums. And here on this slide, we have 4 main areas that are receiving changes under LDTI. The first one is the assumptions. Generally, the assumptions were set at the issue date, and formerly they were left unchanged for all the future valuations. Under LDTI, these assumptions must be reviewed at least annually and updated if warranted. The updated assumptions that are used to create the expected cash flows, like those expected benefit payments and the expected premiums, they're applied retrospectively, and they will be reflected in net income. The updated discount rates, which produce the present values of those cash flows, will be reflected in the AOCI, the Accumulated Other Comprehensive Income. The expected cash flow assumptions should no longer include provisions for adverse deviation. This is a change from pre-LDTI. And the discount rates will be more uniform across the companies. The definition given by LDTI is that discount rates should be based on an upper medium grade fixed income yield. Let's move ahead to slide number 3. The benefit liability at the transition date is similar to purchase GAAP accounting. A benefit ratio is derived. This ratio tells us what portion of premiums is required so that the benefit liabilities under the updated assumptions will match the current reserve balance at the transition date. Another change is in maintenance expenses. Maintenance expenses are no longer reserved. Now they are recognized as incurred. Another change is that reserve releases are not allowed, with the exception being that they would be offset by a deferred profit liability amount. That's sometimes called a DPL. Please let's move to slide 4. The LDTI approach requires calculating benefit ratios back to this transition date, or the contract issue date if that's more recent. As one moves from one reporting date to a new reporting date, the expected cash flows that were predicted for the month that recently ended will be replaced with the actual cash flows that occurred in that month, still going back to the transition date. The data from actual experience gradually replaces those future expectations. In order to track the actual data, the contracts must be grouped or assigned into cohorts. This was likely not an exercise that had to be done by companies before LDTI. And this creates new challenges with the way the contracts are organized and also maybe the type of data storage. Additional governance will be required around these new processes. We don't have all the time in this session to describe how those cohorts work, but just wanted to mention them here. So let's move on to slide 5. At each reporting period, we'll need to measure each cohort's present value of cash flows 2 times. One time we'll be using a discount rate that is the original discount rate for that cohort. And the second time would be to use the current rate, which is the upper medium discount rate mentioned on one of the earlier slides. So you have 2 measures of the reserve. The first one, using the original discount rate, is sometimes referred to as the locked-in discount rate. And the second one, of course, using the current rate, we'll just call that the current rate reserve. So those 2 reserves will be different since they'll have different discount rates. And the difference between those reserves is put into the accumulated other comprehensive income, which is on the balance sheet. So let's move to slide 6. Here are some emerging observations from the LDTI implementation. By removing the PAD, or the provisions for adverse deviation, the reserves grow slower, which produces more favorable earnings. And the interest rate environment has changed, especially it's changed a lot since the initial draft of the LDTI standards were produced. So 2 years ago, interest rates were much lower. And so that AOCI impact on income was unfavorable. And now if you look back in 2022, obviously interest rates in the US have reversed. So that AOCI impact has largely reversed. Also, limited pay insurance has a deferred profit liability amount, which largely offsets the benefit liability movements. The deferred profit liability, or the DPL, is how excess premiums are deferred. I think we can move ahead to slide 7. All right, so the second main topic of the 4 mentioned at the agenda is the deferred acquisition costs. LDTI changes the way deferred acquisition costs are amortized, or how they're treated as well. The method of amortizing DAC, I'll say that for short, will be a straight line over the expected life of the contracts in that cohort, and in proportion to the insurance amount in force. Interest does not accrue on the unamortized DAC balance. This is different than before LDTI. And also the last one here, DAC is exempted from loss recognition testing. I think we can move on to slide 8. Earnings emergence will change from DAC, from this impact to DAC, compared to the old way. The impact will vary. It obviously depends on the mix of business, depends on how the former horizon for amortizing DAC was defined, and so that the difference between the new horizon and the old horizon could affect how that's shown. In fact, the next slide, don't move there yet, but in just a second, we'll show a picture of that. There's 2 transition options, and if you're trying to predict or at least foresee these changes in earnings impacts, consider trying both transition options, if feasible, as a way to decide which one. There's still some outstanding questions. There's some other quantities like the VOBA that are related to, sometimes treated consistently with DAC. There's still some outstanding questions on those. But if we could move to slide 9 now, we'll show a short graph. It's a hypothetical comparison of the way DAC would be amortized before and after LDTI implementation. The upper blue line represents the original DAC amortization. The lower orange line represents the new DAC amortization. And essentially the upper line is much more jagged or volatile than the lower line. And that's because of this new, simpler way of amortizing DAC. It's a hypothetical comparison, but both lines begin and end at the same point. So the difference here is how the earnings emerge over time. We can move on to slide 10. To illustrate how it is challenging to predict the impact of DAC, there could be an offset between the removal of the interest growth on the unamortized balance, and extending the amortization length. There could be situations where a negative DAC amortization is possible, and as mentioned before, other quantities that are related to DAC, like the VOBA, may also change if it was already defined to be consistent with the way DAC was treated. Let's move on to slide 11. There's the third main topic here is market risk benefits. Guaranteed minimum death benefits, which is, or income benefits, which is that GMDB or GMIB in that first box there. Within variable annuities and index annuities will be classified as market risk benefits and have to be held at fair value. Changes in fair value from credit risk will be reported in AOCI instead of operating earnings. The next slide, please. So the volatility of earnings will increase from this change if fair valued rider benefits are predictive. Some benefits in variable annuities already use fair value, so implementing it will not be a challenge. It's anticipated that some companies may try to argue that their indexed annuity benefits are not under this umbrella, but that may be a challenging demonstration. And then we can move on to the fourth and last main topic, which is on slide 13, and this is the enhanced requirements for disclosures. A roll forward must be provided showing how the beginning balance changes to arrive at the ending balance. This disclosure of a roll forward applies to present values of benefits, policyholder account balances, market risk benefits, separate account liabilities, and deferred acquisition costs. The company must also disclose information about the assumptions, methods, inputs, and judgments that are used, and if the information that is disclosed must also include changes in those items and also the effect of those changes. Slide 14, the additional disclosure requirements will be challenging. These roll forwards probably haven't been done before. They display itemized reserve movements. There's going to be challenges on the valuation systems and on the data storage. How do you link those two? And then let's move on to slide 15. We're getting close to the end here. The effective date of LDTI for public companies is January 1, 2023. Non-public companies have a little bit more time, about 2 more years. However, the transition period is 2 years prior to the effective date. So financial statements from 2021 and 2022 must be recalculated. And then the last slide, just to wrap it all up on slide 16, the intent of LDTI accounting is to better align the asset and liability reporting and to make it more transparent. We expect many challenges in the operations of implementing LDTI. DAC amortization will be simpler. Moving market risk benefits to fair value may increase the earnings volatility. And of course, timing is of the essence with this new effective date. That concludes my presentation on LDTI. The next session will be presented by Daniel Schobel and Siddhartha Dash.